Okay, in this video, we're going to talk about some technical analysis skills regarding the Fibonacci tool. So in our ongoing series, small bite size, I guess you could call it, little lessons on this particular strategy that we were talking about today in the membership area, the discussion came down to how I use the Fibonacci tool to determine where price could potentially stop and then reverse. Or continue where it would pull back to and then bounce in a particular direction like an uptrend or a downtrend, and then how I would use the Fibonacci tool to find profit targets. So the first thing that I want to share with you is exactly what I was talking about earlier today, that the Fibonacci tool will work if you're using it on the right area, the right price structure, and you need to learn how to decide and how to figure that out. What is the right price structure? Okay, so one of the biggest challenges, sometimes people will look at consolidation. So we're looking at Bitcoin dollar, we're looking at a 1 hour time frame, and you can see a few ranges of consolidation. You see a few highs and lows. So one of the things that I help all of my coaching students with, and my students when they go through the trading course, I teach them this A, B, C, D price swing method. Very similar to Elliott wave, things like that. There's a lot of different wave patterns that you can use, tools. Again, we're using MetaTrader for this particular platform because I do switch throughout the day, going from cryptocurrency trading to Forex trading. So let's go back over here a ways. One of the first things that you can do is find where, relative to the time frame that you're using, in this case a 1 hour time frame, go back and then find or tighten up the charts. I detached it here with the MetaTrader platform, but go back to one of the most significant lows that you can see in the chart. You might have to tighten up the charts and compress the candles so you really can't see the candle patterns, but you can see the price action is what I'm talking about. And then notice where it shifts. So for example, pay attention and find where a most recent downtrend was, and then the low that took place, and then how it reversed and started to go back up. You'll see it. It's going to be pretty significant. From that point in time, let's just say, for example, this was the low for a particular downtrend, and then it turned around and turned into a uptrend. Well, again, 1 hour time frame relative to the time frame you're trading. You want to start labeling these price swings with this A, B, C, D price swing. So an A low, a B high, and then the C retracement. If this was the turning point from the downtrend to the uptrend, this is where I would start drawing my Fibonacci tool. So we've got the A low, the B high. We would draw our Fibonacci tool from that A low to that B high, and then notice the depth of the retracement. If it was, for example, let's just say a 618 retracement, then obviously we would have projected extension targets based on the depth of the retracement. The deeper the retracement, the less likely it is to reach some of these extension targets that are far off. So we've got different take profit levels. In every trade that I'm going to execute, I'm going to have two take profit levels. The first one is always going to be a safety measure. It's always going to ensure that I lock in profits on these breakouts, and then on the breakout trade, the continuation breakout trade. And then that final target is the final extension target based, again, on the depth of the retracement. So again, based on how deep it retraces, that would determine how far I could expect it to go in most cases. Now, what I see very often, and I know because I made this same mistake, what I see very often is that inside of consolidation, some new traders are sort of not paying attention to the concept of that A, B, C, D price swing method. They're just looking at the most recent, maybe the most recent price action at that time. So let's just say a new trader comes in and they turn on the charts and they see this high and this low. And very often what I see is a trader will take the Fibonacci tool and draw it from that high to that low, and then think that if it retraces to the 618, that's their opportunity to sell it. If it's been in a previous downtrend, they want to sell it right away. That's using the Fibonacci tool inside of consolidation is not going to help you in most cases. You could get lucky where you end up drawing it at that precise low and high, identifying the retracement, and then trying to calculate that, the extension targets. but until it actually breaks out of the consolidation. So I'm going to show you two things here that are going on. The first mistake that I see is that people don't step back. New traders sometimes won't step back and take a look at the overall bigger picture. What's going on here? Did it bounce? Did it pull up? Is there a new range of consolidation? All of that. How do you quantify and qualify consolidation? That's another issue that traders have trouble with when they struggle. They see consolidation, but they don't know how to box in and control that range so that they can determine when it's going to be a true breakout, not a head fake. I teach you how to do that in another video. So one of the things, again, going back to the mistake that I see very often, is they'll draw a low and a high with the Fibonacci tool, and then they'll look for the 618 or something like that, and then they sell it immediately. But the way I see this, again, and this took me years of practice, study, testing, live accounts, live money, I see, and I prefer to look for ranges of consolidation and then count or track my price swings with that A, B, C price swing. So remember, I talked about, let's just imagine that this was a turning point and this was a low from a downtrend and it's about to start moving up higher. Well, we don't know for sure just yet, but at least at this point we have a new confirmed low. That's another issue. Sometimes people don't know how to confirm highs or lows just yet, so they jump in too quick and start drawing in that Fibonacci tool when it's too soon, it's too recent, and again, still inside a consolidation, and they make this mistake. They try to sell it when it's actually going to turn around and go back up. So I'm looking for ranges of consolidation to box in and then wait for the breakout. So you'll notice I have an A low and a B high, so I could start off here. I don't know for sure just yet, so I can't make any decisions, but I want to track along. Remember, as price and time moves on, there's going to be some price action. There's going to be some activity, and you're going to have to follow along with that until you get clarity. What overrides looking for retracements as opposed to waiting for breakouts? Well, the breakout trade is that is where I have true confirmation that something's taking place. The other issue is, and we talk about this in the consolidation breakout, the continuation breakout trade videos, I talk about how much time has to pass in order to solidify that range of consolidation. So you'll notice here with this new A low, B high, and I can track what's going on here. I wouldn't move it to that spike high. That just looks like a spike high. And you can see by boxing in that range of consolidation with that new A low and that B high, at least at this point. This is with the information that I have. I don't know for sure just yet, but the more time passes and the more time remains inside of this range right here, this consolidation range, that starts to solidify that consolidation range to me. And then I have to wait for the next setup, which would be the continuation breakout trade. But here again, going back to noticing the depth of the retracement, we've got a 382, a 50. The candles seem to be holding, the bodies of the candles seem to be holding right around the 50. There's a spike that goes down to the 786. Now we could start, if it does break out above that B high, then that would be the continuation breakout signal candle. That's the first technique that I developed back in 2001. And then this would signal to me that I could expect price to continue in this upward direction, or the direction that it broke out of. So let's go ahead and take this out a little bit further, and then I'll show you the longer price remains inside of this consolidation range, the more it solidifies this boxed in range of consolidation that I'm using. This is the continuation breakout trade setup that I'm looking for. And then I incorporate that with the Fibonacci tool using what appears so far, this being the most significant A low, B high, C retracement. So it's just a matter of time, right? We're waiting for a 1 hour candle to close above that B high to signal a continuation breakout trade. There's the candle, the first candle that actually breaks out of that range. And again, if you go back to the videos from 2016, 2017, 2018, trading it all the way back up to just under the 20,000 level, we did the same thing. On these breakouts, I did the same thing on the 1 hour time frame, looking for the most significant A, B, C price swings, waiting for the breakout, waiting for price to close above the B high if I was going to be trading it in an uptrend. The same thing happened up here. This was not the same range of consolidation. We needed to identify that this was actually a top here. So in a situation like this, you've got a tweezer top here, 1 hour time frame. The 4 hour chart, I actually called out this trade and traded this with my students. This was July 2018. So With the 4-hour chart and the daily chart, I've got strategies to show you how to identify when we're actually seeing tops and bottoms. There's different patterns. We also incorporate the Bollinger Bands. There's different methods. I talk all about that in those videos. But I just want to show you again, we've got a range of consolidation, and this one is a little bit different. We've got an A high and then that B low. And this B low is, again, solidified. The longer time continues and the longer price stays inside of this overall range right here, the more solidified in my mind that this is the new A high and the B low. Things could change, right? Things could change. You immediately draw, or you could draw after some time and confirm that low. With the Fibonacci tool, we've got a new A high, B low, and now we're looking for the C retracement. If it holds here at the 618 and then a 1-hour candle closes below that B low, then I would expect that price could continue down to, again, determining on based on the depth of the retracement, that would determine where we would take profits. So in this situation, 618, it held there, and then we waited for the candle to close below the B low. That's the continuation breakout trade. Remember, the signal candle, that's the signal candle, that is not the entry. We need that 3-point entry. This is our final target down here at 72.80. So we'll go ahead and take this out again a little bit. That final target over here was 72.80, and we're going to roll this all the way down here to that low there was 73.62, that 67, that low right there, 72.11, and then it rolls back down again and goes as low as 68.52. So the Fibonacci tool, using it correctly, identifying the right highs and lows, using that A, B, C, D price swing method, you follow it along, right? When price takes out the B low, then we make our adjustment. Here's our C, so the A change, the new C becomes the new A. So we would move it along as price takes out that low if this downtrend is expected to continue. Sometimes people get really focused in on just the time frame that they're trading. They only look at the data that they see here on the charts. They're not looking at the larger time frames. They don't know where major support and resistance is. They try to sell it right into major support, but they can't see it on the time frame that they're trading. You've got to be able to step back and take a look at the 4-hour and the daily charts.